Recently, I posted a video in which I explained why I stopped buying rental properties to buy REITs instead. To make it short, I think that REITs generate higher returns in most cases, and that's despite being safer investments and requiring less efforts. I explain all of this in great detail in this previous video, so I'll put a link somewhere on the screen if you want to check it out before going into today's follow-up. This was one of my best performing videos so far, and I saw a lot of interesting discussions in the comment sections with 3 counterpoints coming over and over again. The first one is that you cannot use leverage when buying REITs. The second one is that REITs are less tax efficient. And then thirdly, a lot of rental property investors appear to claim that they are able to earn 25 to 30% annual total returns, which is of course a lot more than REITs. I think that all 3 of these counterpoints are misconceptions. They are hurting the quality of the debate of rentals versus REITs. And so I decided to film this follow-up video to correct these misconceptions. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. And in today's video, we're gonna dive a bit deeper into the debate of REITs versus rentals. But before I get into it, could you please do me a big favor and like this video? It really helped me a lot to grow this channel. And then secondly, if you want to access my entire real money REIT portfolio, I'll put a link somewhere in the description of this video. It will lead you to a landing page on Seeking Alpha, where you can take a 2-week free trial to accept my entire holdings. So the first misconception that I keep seeing over and over again is that you cannot use leverage when buying REITs. A lot of people appear to think that rental properties are more rewarding because you can buy them with leverage, you can take a mortgage to finance a large portion of the acquisition price, whereas with REITs you cannot really do that. You cannot take a mortgage to invest in REITs. But what these people ignore here is that REITs are already leveraged investments. When you buy shares of a REIT, you're providing the equity. It's the equivalent of the down payment to buy a property. The REIT then takes your equity, it adds debt on top of it to buy properties, and so you enjoy the exact same benefits of leverage when investing in REITs. The difference really here is that you see the equity value being traded on the stock market. It's not the total asset value, and this appears to be confusing many of you. So to take an easy example here, if we assume that a REIT has a 50% loan to value, in that case, if you invest $50,000 in the shares of that REIT, it's really going to control $100,000 worth of properties because the REIT is going to add debt on top of your equity. But it gets even better in the case of REITs because your liability is fully protected here. You're not personally signing on the loans, so you're not fully liable for them. The maximum you can lose is your equity, but you enjoy the limited liability of the REIT structure. Then on top of that, the REIT may be able to get better terms than you could when seeking a mortgage. And that's quite understandable because lenders will typically prefer to deal with large, well-diversified, professionally managed, publicly listed companies than a small borrower like an individual person. So please stop saying that you cannot take a mortgage to buy REITs. This is not needed. You're providing the equity when you buy the shares. REIT then put a mortgage on top of it to leverage your equity, so you enjoy the same benefits, most likely with better terms, with liability protection. And if that's not enough leverage for you, you could technically add some margin on top of it, although I probably wouldn't recommend it because REITs are already leveraged investments. Then the second misconception that I keep seeing all the time is that REITs are not tax efficient, and people appear to believe so because the dividend income is taxed as ordinary income. But that's way too simplistic of a view. Here there are many other factors that you need to consider. Firstly, REITs will typically only pay out about 50, 60, maybe 70% of their cash flow to shareholders, and the rest is retained at the REIT level to be reinvested in growth. And all of this cash flow that's retained, you've earned it, but it's fully tax deferred. The rule is that REITs must pay 90% of their taxable income to shareholders to classify as a REIT, but taxable income is typically much lower than cash flow because of non-cash depreciation. As a result, there are a lot of REITs that only have a payout ratio of roughly 50%, meaning that there is 50% of the cash flow that's retained by the REIT and fully tax deferred. Then secondly, a lot of REITs will make dividend payments that will be classified as return of capital, which is also fully tax deferred. To give you an example, BSR REIT is classifying 100% of its dividend payments as return of capital, and therefore all of it is fully tax deferred. Most other REITs may not classify 100% of it, but perhaps it's going to be half of it. But in any case, it's further improving the tax efficiency of the income that you earn from REITs. Then thirdly, whatever portion is actually going to be taxed is also going to enjoy a 20% deduction, lowering your effective tax rate on the dividend. Then fourth thing to consider here is that REITs are much more of a total return investment than rental properties because they have better growth prospects, they have access to public capital markets to buy more properties. Typically, they will also focus on higher growth property sectors sectors like cell towers, industrial properties, data centers. They will also buy mostly Class A properties, which typically have a lower starting yield but faster rent growth. And this is important to consider because the growth and the appreciation is also fully tax deferred, and so your starting yield is typically going to be smaller in any case. Then fifth, REITs are today heavily discounted, trading at large discount to their net asset values in most cases, and therefore I would expect most of the returns in the coming years to come from upside and appreciation, again, which is tax deferred. The dividend is really just a bonus on top of that. And then finally, if all of that still isn't enough for you, you could just put your REITs in a tax deferred account to defer all the rest of the taxes. When you take all of this into account, I actually pay less taxes when investing in REITs than in rental properties. Rental properties can be very tax efficient, but even here there are some indirect costs that a lot of investors seem to forget about. The main advantage of a rental property is that you can depreciate it down to lower today's taxes, but one consequence is that then your cost base is going to be much lower, and so you're never really going to be able to sell that property without being hit with a huge tax bill down the line. As a result, a lot of investors end up just being stuck with the property. They are not able to sell it. Even if the real estate market becomes overpriced and unattractive, they just stick with the property, and that's really leading to significant opportunity costs that really should be considered. So all in all, I think that rental properties are tax efficient, but their tax efficiencies are not quite as significant as some of you appear to think, and at the same time, REITs are a lot more tax efficient than what their reputation appears to be today. And then the third big misconception that I keep seeing online is that somehow people are able to earn 25, 35 or even higher total returns when investing in rental properties, but I really don't think that this is the case. I think that these investors are in reality wrongly calculating their returns, and if they calculated them properly, they would see that the returns are actually quite a bit lower. Warren Buffett became the richest investor on earth by compounding his capital at 20% per year, and so I can guarantee you that rental property investors are not just casually compounding at 25, 30% annually, doing it as a hobby, because if that was the case, we would have many more rental property billionaires. The reality is that real estate is a low margin, capital intensive business with low barriers to entry, and so if there were such high returns to be earned, there will be far more competition, which would then bring the returns to lower levels. I think that a lot of investors are making two mistakes when calculating their returns. Firstly, they will ignore the value of their own time. They will put a lot of work and a lot of time to find a property, to negotiate it, to finance it, to renovate it, to market it, then to manage it later on. All of this requires a lot of time and effort, and somehow they will assume that the value of their labor is free. But that's not the correct way to calculate the returns on your investment, because you could have used all this time and effort working another job and earned a salary from it, and so you really need to deduct this opportunity cost from your returns. And if you did that and you were honest about all the time that you put into finding your property, managing it, and so on, you would see that your returns will typically come down very significantly. So it's not impossible that someone is earning a 25% total return, but in reality, the return that's getting from his investment might be closer to 10% or 15%, and the rest is really a return on their labor. And then the second mistake that people will make when calculating their returns is that they will just look at the returns of a good year, an average year, but they are not considering that when you're investing in real estate, you will have occasionally some major expense items. As an example, you might buy a property and everything goes well for 10 years, and then on year 11 you need to change your roof because there was a leak that caused some damage. That's a major expense, and you should really average it out over your entire holding period to get an average annual total return. Then on top of that, you probably should also look at returns averaged out over a full cycle, including the ups and downs in property values. Again, this would give you a better sense of the average annual total return as you try to compare that to those of REITs. From my experience analyzing and buying rental properties and also working in private equity real estate, in most cases rental properties are really not going to generate much more than 10 to 15% if you're a really good investor, and I think that in most cases you can do slightly better when investing in REITs, again with lower risk and much less effort. Now, if you want to learn more about what REITs I'm buying at the moment, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it somewhere in the description of this video, and otherwise, once more, if you could like this video, that will really help me a lot to grow this channel. Thank you very much, and see you at my next one. Bye bye.